vision. Let me inform you all that Luis is joining us virtually. In fact, this will be a virtual session. So let's get the session started. And with that, let's hear it from Luis Berruga, the CEO, GlobalX.
Passive strategies have played a key role in the disruption of the asset management industry in the US for the past several years. The shift is undeniable. Passive strategies and ETFs have experienced industry tailwinds, not just in the US, but across global financial markets. And this growth doesn't appear to be slowing down anytime soon. The implication for fund houses and distributors has been varied, and the key factor comes down to the structure of these businesses. Active fund shops generally have strong distribution agreements in place, which can be quite costly, and they tend to charge relatively high fees, driving healthy margins. The decision to enter or support the ETF market can be quite challenging given the lower fee structure. However, many firms have found that the broad reach of ETFs opens them up to a much larger base of investors. Ultimately, the potential is there to capture a much larger base of assets, which has been key to survival for many large established fund houses. And the proof is clear. Financial advisors love the ETF structure. ETFs have been a revolution with global assets at $7 trillion in the US and over $10 trillion globally. This rise of ETFs has been driven by various features of ETFs themselves, which give financial advisors and investors a higher level of control, driving a recalibration towards the use of passive ETFs to better serve clients. First, ETFs are generally much less expensive than their respective mutual funds, and therefore allow for more cost control over the investments. Second is the ability of financial advisors to manage tax implications for their clients. The create and redeem structure of ETFs delivers a unique tax benefit to investors relative to mutual funds. In a traditional mutual fund, investors can be exposed to tax liabilities which are generated by other investors' activity, completely outside of their control. With the ETF structure, investors are insulated from other investors' flows, creating tax liabilities. Over the long history of the ETF industry, there is very compelling data to show that this structure is inherently more tax efficient than mutual funds. Helping clients limit their tax liability and therefore keeping more assets invested for growth is a key feature that has clearly driven extensive ETF adoption. Lastly, the fact that ETFs are generally passive in their approach, combined with a wide variety of funds offered, means that advisors have access to very precise tools to help manage their asset allocation. One of the challenges with mutual funds is something called style drift. As an advisor, when you set up your asset allocation, you might target, say, 20% for large cap growth. If the investment is made with a large cap active mutual fund, it is not uncommon to see value stocks or even small cap stocks showing up at times in the portfolio. This is what we mean by style drift. When the entire portfolio is comprised of active funds, the target allocation determined by the advisor can be incredibly difficult to manage. When passive ETFs are utilized, the advisor knows that the fund will stick to the benchmark criteria and their target asset allocation will be precise. Let's demonstrate an example of this scenario. An advisor may see tremendous growth potential for the future of robotics. Odds are that there are not active mutual funds that are solely focused on this disruptive sector. By utilizing an ETF, the advisor can gain dedicated exposure to express their view. If there is a robotics dedicated active manager, they may shift around the assets and possibly miss out on the growth that was expected. With an ETF, you know exactly what you own at any point in time. The shift that the US market has experienced from active to passive is happening in other markets around the world. including India. There are several lessons that countries like India could learn from the West in regard to passive strategies and their disruption of the asset management industry. While active managers may have a good story and offer the potential to outperform their benchmark, the historical data in the US shows that this is incredibly difficult to deliver. In 2021, 79.6% of all domestic equity funds underperform the S&P on an absolute basis. Clients are perhaps more willing to overlook this due to a stretch of historically great returns for equity markets overall. But with recent volatility and the prospect of inflation and rising interest rates for the first time in many years, investors are likely to be more conscious of fees, particularly if overall returns lag. While ETFs are usually a lower cost, more tax-efficient vehicle that offers precise exposure, it is still very rare that advisors only use passive investments. Some asset classes may offer a higher potential for outperformance, or an advisor may have a firm conviction on a particular manager. The vast majority of advisors in the US are utilizing a blend of both active and passive to deliver the best client outcome. In the US, the rise of passive investing and ETFs has coincided with a big shift towards a fee-based management model. This is a model where advisors are compensated on a percentage of the account value versus one-time commissions or trailing payments from investment products. This model puts the advisor's incentives squarely in line with the client who most likely is looking to grow and preserve their investment capital.